Good afternoon and welcome to the webinar. It's Friday, March 13th, and today we have the whole team from Morey and Quinn Wealth Partners, Pauline Quinn, John Morey, Mike Morey, and Katie Bruno. And given the recent market volatility and coronavirus, we wanted to put together a webinar for our clients and friends to give them our thoughts and opinions. Today's discussion, we'll talk a little bit about the coronavirus, the market's response to the coronavirus, and then investor behavior. And then at the end, we'll give you some actionable steps because we always want to leave you walking away with something that you can do. So I'll kick off and just talk a little bit about what's happening. So less than 10 weeks ago, China reported the existence of a new virus to the World Health Organization. The virus is now what we know as coronavirus, or COVID-19. The virus is spread quickly across the city of Wuhan and throughout China. And it has now reached the U.S. among many other countries. The market had been reacting to this over the last few weeks. We saw some down days. We also saw some up days. And then over last weekend, there was a dispute over oil between Saudi Arabia and Russia. There had been a decrease in oil demand coming mostly from China as a result of the coronavirus. And so Saudi Arabia, what they did as a response to that was they increased production. Instead of cutting production, they decided to increase production and then cut prices. And this was kind of seen as a political move, expecting that other countries who needed oil would buy from them as it would be cheaper. And so Russia fired back, and then a price war began. And this oil uncertainty added to the coronavirus uncertainty. And so when the market opened on March 9th, we had a circuit breaker triggered. And circuit breakers are rules that are set that represent different thresholds at which trading is halted. So if the market declines by a certain percent, the circuit breaker is triggered and the market stops trading for an amount of time. So the market dropped by 7%, and so the market stopped trading for 15 minutes. Then on March 11th, the World Health Organization declared coronavirus a pandemic. And a pandemic is the word used to describe a disease that's been spread over the whole world. So the market reacted to this. The Dow Jones Industrial Average closed down more than 20% lower than its record high, and that's what we would call a bear market, a decline in more than 20%. In the evening of March 11th, President Trump announced a 30-day travel ban on Europe. He also announced some ideas for a stimulus package, including cutting payroll taxes, pushing back the tax deadline, or adding additional funding or loans for small businesses. When the market opened on March 12th, the day following President Trump's announcement, the market dropped by 7% again, triggering the circuit breaker. At this point, the S&P 500 index had dropped, and so the S&P 500 entered the bear market. So both the Dow Jones Industrial Average and the S&P 500 had entered a bear market. As a response to that, the Federal Reserve announced a plan to inject some money into the bond market. We didn't see a lot of market movement from that announcement on March 12th. So what we would call this event is a black swan event. And a black swan event is the name used to describe something that's unexpected and quick. And we're seeing a lot of businesses and agencies suspending events, travel, universities are closing. And all of this is done without having any history to look at in terms of what's happening with the coronavirus. Now, today, as we record this, President Trump just declared this a national emergency, which by doing so, this will allow them to tap into funds that are set aside for only national emergencies. At this point, I'm going to hand it over to Mike to talk a little bit more in depth about the coronavirus itself.
Thanks, Katie. Good afternoon, everybody. These next couple of charts are from McKinsey and Company and go over some of the statistics of coronavirus. And before going further, I want to make a point and make it important that, we are not medical professionals. So this is just our opinion, and we're looking at the data. So when discussing specifics, especially, about the coronavirus, it's important to talk to a trained medical professional such as your physician. So with that being said, you can see here on this chart from McKinsey and Company, the countries that have been impacted the most so far by the coronavirus, and we know this is seems like it's changing by the minute. But as of now, there's almost 100 countries that are reporting cases of the coronavirus. And as of this chart, there was over 105,000 total reported global cases. And as I'm sure you know, that number is rising daily. The chart also shows the different phases that the different countries are currently in around the world. You can see the U.S. there on this chart is in stage 2. It would be my guess that after President Trump declared a state of emergency, that we've now probably crossed into stage 3 there, which involves government action and a shift in public behavior. Though we've certainly seen public behavior shift even before today with the cancellations of sporting events in schools. You'll see there also the stages that Spain and Germany are in. Italy has probably been hit the hardest by all of this. The country is basically on lockdown and in quarantine. The medical field is on the brink and being stressed to its limits. But I'd also like to point out this chart shows China in stage 5, which is considered the number of new cases is dropping and activities are resuming. Now, one might argue, can we really trust the information that's coming out of China? But nonetheless, if that is the case, I think that's promising. And when we're looking for positives in all of this, that's certainly something to take into consideration. If we go to the next chart, again from McKinsey and Company, this shows, compares the infectiousness and the fatality rate of coronavirus or COVID-19 to other infectious diseases. And the bottom axis, the horizontal axis there, shows the fatality rate, the percentage of deaths among cases. The vertical axis shows how infectious the disease is. So, as of this chart, as of the time of this chart, you can see that it's actually more infectious than Zika or, say, the influenza of 57 or 2009. But it's still less infectious than the SARS virus or polio or chickenpox and the measles. The current death rate on this, the fatality rate, you can see is about 2%. It seems to be more fatal than certainly Zika. But my guess is, and again, we are not medical professionals, but my guess is that this chart and these figures will change daily as more and more testing becomes available and more cases are reported, and we start to really get our arms around some facts and figures involving this coronavirus. So while this chart shows that it's more infectious in certain diseases and more fatal than certain diseases, like I said, I expect this chart to change drastically over the next days and weeks ahead. The next chart just shows how drastic of an effect that not only the change in the energy market that Katie discussed, but also the fear of the coronavirus, just exactly what it has, the effect that it has had on global markets. You can see the different markets there on the charts going back to basically February, a couple weeks ago, where we were compared to where we are now. And really what we're dealing with is it's a fear-driven market right now. We don't know enough and have enough facts in front of us, which is then causing fear, which we've seen in the sell-off of the market. Some questions will be, what's going to happen to the market if the number of confirmed cases increases dramatically, or if the fatality rate decreases substantially. We believe if that were to happen, we could be in this volatile market for the foreseeable future. If we do get some improvement in the figures, if we get some facts, and we get some good news, and we start to see a decline in the number of new cases in the U.S., I would venture to guess that we should start to see an improvement in the markets and hopefully some recovery from the drops that we've seen over the last several weeks. There's also a question of whether the federal government's involvement, whether it be a stimulus, or the declaring of the national emergency, if that will help ease investors' minds. All that's obviously to be seen and to be determined. But again, the more clarity we can get on this coronavirus, the more testing that becomes available, and the more fear that we can put at ease, the more facts that we can obtain. And so we're not just dealing with hearsay and fear. I think will certainly help the markets calm down, and we can start to see hopefully a rebound. This next slide shows the investor behavior, which I'm sure most of you are going through, which is perfectly natural and normal. On the left there, you can see when stocks are rising, we're happy. We have optimism. Optimism then turns to excitement when the markets are doing really well, some euphoria. And then as the markets start to creep down, we go through denial. Right? And, this is only temporary. And then maybe some regret when we start to bottom out. Then the markets come back up. We start to have optimism again, then maybe some overconfidence. And I would say right now, for the most part, we're probably on the far right side there of the picture. We're in fear and panic mode as far as investors. And investing is certainly an emotional game. And game is not the right term to use, but it's money is emotional, and it's certainly real. But it's important to keep a cooler head during these times and not make emotional decisions. When we start to make decisions with our emotions, they tend to be the wrong decisions and at the worst possible time. So, as Warren Buffett's always said, be fearful when people are greedy, and greedy when people are fearful. And that's when the markets are doing well and at all-time highs, people are greedy. That might be a time to be fearful, and just to do a quick check of your investment strategy to see if everything's in place. And obviously, where we are now might be a time at some point to be greedy. There's going to be opportunities here in the market at some point. It's just a matter of when, and nobody really knows when that time will be. This next chart goes over the differences between pullbacks, corrections, and bear markets, and the definitions of them. You'll see there, since the end of 1945, we've actually had a total of 57 pullbacks, and that equates to about roughly one per year. And it may not feel like that, especially when the markets are doing well, like we've seen post 2008. But we do have pullbacks pretty much every year. By definition, a pullback can be anything between a 5 and 10% decline, and those happen pretty frequently every year. A correction, which I'm sure you've been hearing in the news lately, as we've seen record high numbers in the market, a correction is technically anywhere from a 10 to 20% pullback. And a bear market, which Katie alluded to earlier, we are currently in now officially, is a decline in 20% or more from our all-time highs. But I think it's also important to note, and JP Morgan has a good chart on this that I would encourage you to look at on their guide to the markets. But since 1980, the S&P 500 has averaged an inter-year drop of almost 14%. That's every year since 1980, it's averaged a decline of 14%. And that's scary to think about. But then on the flip side, in that same time frame, since 1980, the markets have still managed to post a positive return 30 out of those 40 years. So that's important to, keep some perspective there. And for example, just 2009, we all remember how bad 2008 was. And people forget that in 2009, the market had actually a pullback at one point. We were down 28% at one point in 2009. And yet we still managed to, by the end of the year, to have a total return, a positive return of about 23%. So again, perspective is always key in times like these. And it's important to, take a step back and look at facts and figures. So with that, I'm going to turn it over to Pauline Quinn to talk about, the different types of risks that there are in the market and what we're experiencing right now.
Thanks, Mike. This, the chart you're looking at right now is not meant to scare you. It's talking about the kinds of things that cause turmoil in the market. Liquidity risk, credit risk, operational risk. What we're experiencing right now is market risk. The coronavirus could be categorized as a natural disaster, and that comes under the category of market risk. When investors face the risk of losing capital or the prospect of not making profit on something that they own, they can get very irrational and emotional. Their responses change, influence how the market goes, and causes wide fluctuations, which we call volatility. Frenzied selling and frenzied buying cause significant changes in the market and prices of the stock as people are trying to avoid losses and acquire more gains. My advice is to not listen to the noise around you with the media and stick to your plan. Investors with a financial advisor have a plan. Remember what your plan is. This next chart talks about bull and bear markets throughout history. What happened on March 12th is being compared to the same percentage downturn of the market in October of 1987. It just so happens that I was working in the industry on that Monday. And at that time, we had double-digit unemployment, double-digit interest rates, double-digit inflation. The 1987 downturn was definitely economic, whereas this downturn is definitely caused by the coronavirus. The natural disaster risk that the coronavirus is causing in the market has definite economic effects. It's going to cause short-term losses for companies, for corporations that we all own. In my opinion, fear is causing the market to be way oversold this time. Fear and panic. When I look at the chart, these events are very real and were very real and emotional to investors at that time. But keep in mind, a lot of these events occurred before we had 24-hour media.
Thanks, Pauline. This is John. I'm looking now at slide number 11 on your screen. Funny that we'd be talking about sports when we're looking at crazy market activity, but sports is on the minds of everyone right now as we look at cancellations of tournaments and things of that nature. Nobody likes to lose, whether it's football or basketball or any sport or in any other part of life where there's the possibility of winning or losing. It's the same with money. Nobody likes to lose it. When it comes to winning or losing with investments, concentrate on a long-term perspective and on owning high-quality investments? Do you see yourself still liking the business or service or product that the company you're going to invest in 5 years from now or in 10 years from now? If not, then reconsider your investment strategy. Short-term swings in the stock market cause lots of worry and frustration, but in reality, what the market does on any given day, even in a series of days, is irrelevant to your long-term goal. Downward swings in the market create buying opportunities, not signals to sell. Always invest in high quality and ignore the daily gyrations. They'll drive you nuts. Turning to the next slide, this chart illustrates the results of two investors and the results of their actions in the Great Recession, which was basically from late in 2007 through March of 2009. And then it continues on through January of 2019. In 2008, using the S&P 500 index as the measuring stick, the market went down about 37%. Many people bailed out, selling stock in their perfectly good companies at low prices, even losses. What most people didn't realize is that starting with the bottom of the market on March 9th of 2009, the stock market grew about 25% in that calendar year. And it continued to grow in what has become one of the longest growth periods in history. Investors who sold out during that time not only had losses in their sales, they lost out on a lot of growth in the ensuing years. The numbers on the chart bear this out. Think long term. So looking at the next slide, number 13. What should one do when the stock market has lost its mind again, and it appears that the world will come to an end again? Number one, fight fear with facts. With so much news media and noise coming at us, it's hard to discern what's real and what's not. Listen only to credible news services, ones that don't use hype and fear-mongering to boost their ratings. Question every so-called fact that you hear. 2, partner with a qualified financial advisor, someone who has more information than you, someone who has far more resources than you, and someone who understands the value of high-quality, long-term investing. 3, review your plan, not because it needs to be changed, but because you want to be reassured it's still the right plan for you. Your financial advisor will be a great help in this. 4, from a tax perspective, even though it doesn't sound like fun, sometimes it's a good idea to take a loss. Don't ever fall in love with an investment. Number 5, take advantage of ways to invest money in a tax-deferred plan, such as an IRA or your company's retirement plan, or other ways where you can put money away and enjoy a tax benefit by doing so. Number 6, for some people, prepaying gifts or taxes or expenses in a given year could be an advantage for them tax-wise. Number 7, look for opportunities to refinance debt at lower rates. With interest rates still hitting historical lows, you may be able to save yourself lots of finance charges by refinancing your home, even your car.
Thanks, John. And thank you to all of you who are listening. I provided our contact information here on the last screen, so please reach out to us if you have any questions. We're always happy to sit down and talk with you and go over a number of things that we discussed in our webcast today. Thank you.
Thank you. Stay safe.
Goodbye.
Bye.
It was long.